One financial analyst who spent 2 decades studying the markets agreed to a rare on-camera appearance to issue his biggest warning ever. He says the biggest market bubble in history is popping. So you can do nothing or take this one simple step to prepare now. This past winter, he began issuing a big warning about inflation and a looming market disaster. His timing was nearly perfect, but he promises you there's still time to act, to protect yourself, and potentially see some of the biggest gains of your life in the coming years in the right time-tested assets, ones that tend to skyrocket in times of inflation, like hard assets, energy, and gold. He's put together a 5-stock model portfolio, a way to not just beat inflation, but benefit from it. This dead simple one-step investment approach could show you a series of triple-digit gains or higher starting right now. You could set yourself up in minutes and likely forget about inflation, rising prices, or the worst effects of a market crash for years to come. The critical thing is that you act now. Do your future self a huge favor and get the facts free of charge. To watch our full interview for free, simply go to inflationprotection2022.com. Again, that's inflationprotection2022.com to watch our full interview. Hi, this is Daniela Cambone. Welcome back to our summer series here on the Daniela Cambone Show on Stansberry Research. Well, my next guest today says, you know, the world is just falling apart. We're going to get his thoughts on his thesis, why he thinks this is happening. So please welcome to the show, Michael Gayed. He is the portfolio manager over at Toroso Investments. He's also the publisher of the Lead Lag Report. And it is the first time he's appearing on my show. So Michael, I followed your career for a very long time. Nice to finally meet you and welcome to the show.
I certainly appreciate the invite. Thankfully, this show is not going to fall apart.
Thank God. Fingers crossed. Michael, so like I said, you started one of your tweets, you know, I follow you on Twitter. It's such great food for thought, and I really want to pull out some nuggets from you today. But first, let's talk about the big news on hand here. Senate Democrats narrowly passing the Inflation Reduction Act on Sunday. The legislation now heads to the House, which plans to return from its summer recess on Friday, pass the legislation and send it to Biden for his signature. Let's get your thoughts on this 755-page bill, which includes $430 billion to combat climate change and extend healthcare coverage, paid for with savings on prescription drugs, and most importantly, taxes on corporations. Michael, thoughts on the act?
Yeah, so, I read the full 755 pages while barbecuing over the weekend. So a few things. First of all, we can debate the merits about the underlying pieces of the act and what it does for those that want to take action on the climate. But my biggest problem with it is the name. It's unequivocally a misnomer. There's nothing that's inflation reducing about 750 some odd billion or $739 billion in the act. Now, people will come back and say, okay, fine, so we're going to spend money, but we're going to tax to get that revenue back. Okay, I'm down with that. The problem is that still doesn't necessarily reduce inflation. Right? Even the CBO has said that you might reduce inflation in 2 years by something like 0.1%. And by the way, the CBO is notoriously wrong with its estimates historically, right? But more so than that, I find it, while it's good to tax, billion-dollar firms on the profit side, at least a minimum of 15%, I'm okay with all that. My biggest problem with it is that we've seen time and time again that with every spending bill, it's never used to actually pay down debt. It's used as justification to do more, right? You have this really strange dynamic where you have an incentive for politicians to keep spending more because they have the cover of more tax revenue, right? So that to me is where I think this gets to be problematic. And the final thing I'll say is that this is over 10 years, and $739 billion or whatever the number is ain't going to be the same a decade from now.
Right. So, and like you said, you say pay down your national debt. That's the real Inflation Reduction Act. But when's that going to happen, Michael?
Yeah, we are going to both age quite a bit by the time there's even talk about that.
Well,
but really, this is an important point, and it's not a political statement because both parties are to blame for this, right? Yeah. You really want to stop inflation, you've got to pay down $30 trillion of government debt, full stop. So if you're going to raise taxes by $1, then you got to cut spending by $1 or $2. You can't simply make it neutral because it's never, ever neutral.
Okay, but that said, I mean, that number is just, we can't even fathom that number. So what's your take on them combating inflation? I mean, will they ever be successful? How does this play out for you?
There's kind of a bigger existential question that comes from that question, which is,
please,
can you have democracy and capitalism coexist? Now, I know that sounds dramatic, but consider that the only way you get elected is with spending, is by promising more. Austerity doesn't get you in office, right? Austerity was talked about was the buzzword during the 2011 Eurozone crisis, and then suddenly everyone forgot about it because the ECB deleted or changed the definition with QE. So my point with this is that you're never going to have a situation where politicians say, let's do the right thing, let's take the pain now, let's reduce debt, let's increase efficiency, let's not be as bloated as we are. Because the average American hears that and says, well, that means that you're not going to go for the social spending programs that I believe in, right? So it's very hard for me to imagine a scenario where you have any democracy that actually ends up having a strong fiscal balance sheet when there's no incentive to do so.
Right. So that said, like I said, it's your first time on the show. I'd love to also get your thoughts on where you think the Fed will be heading then with their interest rate policies. I mean, do they just keep raising rates here, or at one point they're going to have to say we can't and reverse course?
Yeah, so I always laugh when I hear people say the Fed has inflation under control. The Fed does not have inflation under control. Oil has inflation under control. When you look at where U.S. small caps bottomed intraday, Russell 2000, bottomed June 16th. When did Treasury yields top and bond prices bottom? Intraday, June 16. It is not a coincidence that those two areas ended up rallying after having a big decline a week and a half after oil peaked, a week and a half after energy peaked. You cut off the hyperinflation tail risk if you cut off the oil price surge. So I think the Fed could actually end up, perversely enough, end up over-tightening. Because if they misread the direction of oil, they have to essentially forecast, I would argue, the direction of oil. Well, then they may end up doing the exact opposite thing that they want, and probably, yes, then the game repeats where they end up reducing rates, they end up reinitiating QE, and the Ponzi scheme continues.
Sounds like a likely scenario, no?
We've seen it time and time again. So look, every single response by the Federal Reserve to any crisis is to do one thing only: liquefy, re-leverage. Mm-hmm. Well, then your starting leverage every time gets higher and higher. So if your starting leverage every single time gets higher and higher, your fragility must increase every single time, which means you end up having these 1 in 1,000-year events happen almost every year in terms of tail risks. This is the problem with debt. It leaves you very, very fragile, right? So the Fed can't take the pain because it's not politically palatable.
Right.
And it's very hard to engineer a deflation pulse without breaking the system. So they keep kicking the can down the road. At some point, the can's going to kick back. You know, that's what everyone's been arguing for a while. But clearly, the Fed is very creative at preventing creative destruction. And we don't choose the cards we're dealt. We just choose to play the game.
So let's bring up, you tweeted this back in June. You basically called it. You said, we could see an enormous shock rally in both bonds and stocks because these would temporarily lower inflation expectations enough to give the market breathing room. So here we are, 3 straight weeks of wins for the S&P. My question to you, Michael, is it a bear market rally or are lower lows in the cards for you? How do you see it?
Okay, so let me take a step back for a second. So I'm a portfolio manager. I've got 3 funds, a mutual fund, 2 ETFs. They're all by nature risk on, risk off. So in my world as a portfolio manager that's following a rules-based approach, I don't care so much about the endpoints. I care about the dance in between the endpoints, the sequence of returns. If anybody's followed me on Twitter, you know that I talk about this idea that the first 6 months of this year has been hell, because the problem this year is something that is that markets behave in a way we've never seen before, not in terms of stocks going down, but in terms of stocks going down heavy as treasuries also went down heavy. This kind of correlation of risk off turning risk on, where stocks and treasuries act the same. So they both fell off, then they both rallied starting June 16th. The question becomes, if it's a bear market rally, what would confirm it is stocks going down while treasuries keep going up, yields keep dropping. Mm-hmm. In other words, the sort of return of a classic risk-on, risk-off dynamic, which selfishly I really need to see for all of my funds because they've gotten hit pretty badly on this, what I would argue, very anomalous period. When I look at various intermarket relationships, I think the stock market is misreading the message of the bond market here, because the problem that the bulls are going to have from a longer term perspective is that housing has a long way to go in terms of dropping in price, dropping in cap, right? At the end of the day, affordability has to come back in. Housing has to break in order for inflation to really break beyond what we've seen in the stock market. So that's going to be a longer term tailwind. That's why lumber prices seemingly keep going down. It's not normal to see markets very strong as lumber prices are collapsing. Why? Because lumber is a key component to housing. Lumber is a better way of knowing what housing starts are likely to be than housing starts themselves. So there's a divergence happening as you've had this rally, which to me suggests more that this is a natural sort of bear market relief rally, which is what you see in other bear markets. And one final thing I'll add is, in July, I said, watch how quickly the narrative changes as markets go higher, early July.
Right.
And suddenly the media is all about, oh, well, maybe recession's not going to happen. Narrative always follows price, right? Full stop. At the end of the day, if you're going to manage portfolios, you have to worry about the leading indicators. And the leading indicators for now are still saying that this is not necessarily a secular term, but is maybe just a reaction to everyone being so bearish at the same time.
So I guess on that point, two things. How far away do you think we are from that reality of housing prices coming down?
Yeah, it's going to take time, right? Because you're not going to have this suddenly break in the same way it did in 06 to 08. And keep in mind, you do have institutions out there that are keeping these properties on the books, are not going to be forced sellers. But you do have to resolve this issue of inventory and people also, in reality, selling off their second, third, and fourth investment homes, right, which they're renting out through Airbnb and Vrbo. I mean, a lot of the housing inventory issue, I would argue, is largely also because of property as an investment as opposed to your first home. So you got to force some selling there for inventory to really increase in a meaningful way. If mortgage rates do stay roughly around this level and inflation keeps on staying elevated, that has to choke off demand for housing. That has to cause a drop in prices because people will say, well, I can't afford my mortgage payment. I got to get 2 or 3 homes, which is why the part-time number was so high in the jobs report.
And you mentioned recession before. Just curious to know which camp you fall in there. Based on the data you're seeing, where are we at?
So usually when you're below the 200-day moving average with the S&P, that tends to occur more often than not when you're in a recession. In other words, the stock market sees it before the BLS does. The thing with the recession definition is that we're in a really weird dynamic where things are seemingly very off cycle. A lot of things are not making sense and not kind of correlating the way they used to, and causation seems to be all over the place. It wouldn't surprise me if you're in a recession now, even though it may not technically be what one's definition is. It wouldn't also surprise me if you end up having a much bigger recession down the line, because again, housing tends to be the real precursor to major recessions and contractions in the economy. And again, I think that's still very early. But again, as an investor, you don't have to worry about whether it's a recession or not, because markets are supposed to be, at least in theory, forward-looking. They often get that forward-looking aspect wrong, but it's just an interesting dynamic because on the one hand, you can make a very contrarian case that if everyone believes a recession is coming, it can't possibly come. Right? That's one bullish argument, right? That it's not going to be a recession. But then the other argument is that almost a degree of reflexivity, where if what one believes to be true is either true or becomes true. So if everybody, including corporations, believe a recession is coming, they start acting on it, and then the recession comes because of their fear of the recession. So there's a lot of different ways of interpreting what's happening on the economic front. I don't think it's as important from a portfolio management front.
Got it. That said, sectors that you're liking right now, Michael, is there anywhere safe?
Safe is a loaded word in our industry, right? Because it's like even the term risk off, right? So treasuries historically are the risk off asset because they benefit from stock market volatility. Not my opinion. This is just pure fact. But risk off doesn't mean there's no risk, because risk off is really about default risk off, right? And the U.S. government won't go default because it can print dollars. At least that's in theory. So let's talk more about where is vulnerability less likely to occur. We've seen a lot of outperformance in utilities, consumer staples, and healthcare, right? And that can certainly easily continue, which means they probably, on a relative basis, still make more sense if you believe that it's going to be a longer road ahead, and difficult road ahead. Having said that, the best way to avoid a drawdown is after one's already taken place. Best time to bet on an anomaly is after the anomaly has had its own anomaly. I would venture that probably the best thing for investors to do is to consider treasuries again, right? Because historically, treasuries again act as the safe haven play, in quotes, because yields tend to drop on the long end as stocks go down and there's more volatility. So I think everyone is especially on Twitter, I think, beholden to recency bias. They think that what's happened with treasuries the first 6 months of the year is going to be the way that's going to continue going forward. My argument is that if that's the case, that's a very nasty setup for everybody, because that means you have lower capital gains from a dropping stock market and higher interest expense. Good luck as far as the deficit goes. But why not consider the idea that diversification may again work?
Yeah.
And diversification is not oil and commodities.
Yeah, and so I want to elaborate on this, but you're not the first expert to come on talking about this treasury
Don't
play.
call me expert. You're gonna have all kinds of haters, if you call me, expert.
Okay, well, whatever you want to call yourself, pundit, financial guru, but anyhow. Okay,
Guru seems a load of work.
so let's go down various routes here, okay? First, this was your tweet back in June 18th, 2022. Last week, probably near-term capitulation for stocks. This weekend, probably near-term capitulation for crypto. You called it here. Where do you see crypto headed? Okay, let's break it down because crypto is a general word. Where do you see Bitcoin headed? Okay, and I want to know what you're seeing on the institutional front, what the interest is like.
Okay, so full disclosure, as a member of Toroso, the advisor that I'm under, in addition to my own funds, we're the ones behind the blockchain ETF, BLOK, our largest blockchain ETF out there. So we talk about the space quite a bit, and I often talk about the space not from the standpoint of whether it's going to go up or down, but more in terms of sentiment and narratives, right? Again, as we've seen, not an inflation hedge, not a store of value, something that is a speculative investment that may have its time as a less volatile investment, but is obviously not there just yet. Okay, so I think a lot of the what we've seen, which you can argue was a little bit of a great financial crisis equivalent for the cryptocurrency space, a lot of the excesses have been wrung out, right? With all the headlines around various exchanges going under and the leverage coming out of the cryptocurrency space. That's a good thing, right? You actually want to see that if you're a long-term investor. You don't want to see excessive leverage, because excessive leverage is how you get crashes, right? It's always the necessary precursor. Okay, so now you've probably eliminated that risk. I don't think you've yet eliminated the correlation risk, though, to equities. Meaning that if equities were to keep going down, if there is a resumption of the decline, I think, unless something dramatically changes in the causation and the institutional adoption, it's still going to act like a levered equity play. Now, this does slow down institutional adoption, right? What we've seen here is a drop in institutional adoption, not necessarily one that I would argue is permanent, but whether it just delays the adoption, because look, the reality is institutions need to model out returns, and it's very hard to model out returns with something that can go down 30% a week. Right, so volatility, yes, I understand it's a feature, not a bug of the space, but it's not exactly institutional friendly, right? When you have longer term expected return assumptions, is kind of my point. So, bottom line, a lot of the excess leverage and sentiment has, I think, come out. That's a good thing. I have no idea if Bitcoin is going to take over the world. Neither do the maximalists. I don't care what anybody says. Nobody knows what the future holds, including me, right? So, I think it has a place in one's portfolio. I think, like everything else, it's not about what you own, it's about how much you own of it.
But where do you think the money's going then? If it came out of Bitcoin, where's it headed? It's obviously not in gold right now.
Yeah, it's interesting because it may just be going into the dollar itself, right? Given the way the dollar itself has been rallying since, the initial peak back in 2021 of Bitcoin. And we've seen, obviously, the dollar has been unrelentingly strong. People are just really parking into U.S. currency. By the way, on a side note, almost like there's a sovereign debt crisis coming. I mean, usually when you have a sovereign debt crisis, you see it first in currency movement. The way that the dollar has acted against the euro, against the yen, is, I think, actually quite disturbing if it doesn't reverse soon. But it could very well be that the irony of all this is that as much as everyone in the Bitcoin community hates on the dollar, justifiably so, the dollar has pretty masterfully outperformed pretty much everything, including Bitcoin, in the last year and a half. Yeah, okay, I understand to zoom out, but it is curious to me that in what many would argue is an inflationary recession, the dollar ends up being the biggest beneficiary.
Right. Okay, so I want to get back to your point about the sovereign debt crisis, but why isn't it, do you have any insights as why it's not gold? I mean, with inflation where it's at, why isn't gold performing? This should be its shining moment, right?
Yeah, no, so a couple things. So it's interesting that commodities and gold, obviously, as a part of that, have done so well with a strong dollar, whereas traditional wisdom, in quotes, would argue that commodities benefit from weak currency. Right. So I'd actually argue there's a lot of interesting kind of relative strength there, which is intriguing. But I think people get gold wrong. So first of all, gold does tend to act as a safe haven, flight to safety type of play when you have high volatility in equities. The problem, which I've heard from a lot of people, is that, well, it's not, what we've seen this year is nowhere near enough to justify the last decade of nothingness with gold prices. And the question is why? I don't think it's because of Bitcoin. I don't buy the argument that money has gone into Bitcoin as opposed to the gold, because you're talking about two totally different demographics. Mm-hmm. When you actually look at gold investors, they tend to be older. You look at Bitcoin investors, they tend to be younger. They're not necessarily crossing over in that Venn diagram, right? So I think there's an element of that. And I do also think that asset allocators will push gold higher when you're in a prolonged bear market, because when you're in a prolonged bear market, you have to think about how do you diversify. And you don't diversify with 60-40, 60 stocks, 40% bonds, where bonds have credit risk, which is correlated to the beta. You diversify by being in something that really has a correlation of 0 to most things, which is gold. So it could be simply one of those things where you need more pain for longer and more uncorrelated proof that gold can serve as a diversifier in that pain for gold to really get a bigger bid.
Okay, and to that point, but could you imagine if that money were to just start to come back into the gold sector, would it not just blow up the price right now?
I have little doubt that the madness of the crowd is very good at blowing everything up, both up and down, right? So you're exactly right, and that's the kind of thing about momentum, right? All the narratives around an investment change the moment you have momentum in any asset class, right? Because people chase. Fear of missing out is more powerful than a story. So, but the problem with momentum is that you need momentum to start. So you're right. Maybe if at the margin some of those dollars do go to the gold, it creates some kind of momentum, and then there's a self-fulfilling momentum cycle from that. Certainly possible, and given the way with which people simply follow trends and follow indicators, would suggest that could be a story that could make gold really explode higher. But I could also have said the same thing 2 years ago, 3 years ago, 4 years ago. The timing is always a challenge with this, but is there potential for gold to really substantially outperform? No question. Is there a chance for it to substantially underperform? No question. That's why you should consider it.
Michael, I want to get back to your point about sovereign debt crisis. How close is it? How near is it? And how can you prepare for it? What should we be doing?
Yeah, and to be clear, it's not like I'm trying to be a doomsdayer when I say that. I have no idea where it would come from. All I'm seeing is that when currencies act more volatile than equities, that is a real problem, right, for the entire globe. So it is curious to me that with all this liquidity, the dollar has been so unrelentingly strong. It is curious to me that the dollar has taken out more liquidity than the Federal Reserve, right? Because an appreciating currency is a way of exporting inflation to everybody else. And yet we still have very high inflation here in the States. So I look at that and it just makes me scratch my head. How does this make sense? It's not because of interest rate differentials. I don't buy any of those arguments because the dollar started rallying before any central banks really that mattered in a big way really started taking action. So I think given the way the dollar has acted here, you're pretty much close to a breaking point. Either it's going to reverse and then ease concerns of what could be some real stress in dollar funding markets, or you're going to have a spike, and that spike is caused by something, maybe an emerging market that goes belly up in terms of paying sovereign debts. Who knows, right? That's the thing with this stuff. It's the market often has subconscious trends that happen, moves that occur because of some kind of subconscious aspect to the sum total of the crowd's wisdom. And then we only know after the fact what it was that was bothering the market. I don't know what's causing the dollar to rise as aggressively as it is. A lot of people will claim to. I will not believe them. All I know is that when you have this kind of movement, you got to pay attention.
Well, there's various theories floating around. One, the Fed is doing it at all costs. Keep the dollar high to not risk losing its reserve currency status in the world. Others would say, well, it's not really. It's just the best horse in the race right now. I mean, what do you think of this kind of thought that's circulating?
Yeah, as is usually the case, the truth is probably a combination of all these things and somewhere in between all these things, right? But it's always about the speed with which something happens. Right? I think people get too caught up on levels, right? It's really always about the rate of change that is where things get to be problematic, because if it's too fast, the players involved can't react enough, right, and quick enough to respond to it. So I don't think any of those arguments explain the speed of the move. The speed of the move is more reminiscent of what you see in a real panic and crisis. And clearly that's happened with the yen, right? With Japan trying to control these higher rates by simply destroying their currency.
We hear sovereign debt crisis. It sounds extremely frightening. I just want to make it tangible for the folks at home. I mean, what does it mean for you, and how does it affect your daily life if it were to occur?
It's an interesting question because, look, all this stuff only affects our daily lives to the extent that we need our money in our investments tomorrow, right? Because it means you're going to have a drawdown. You're probably going to have loss. Risk assets will go down. It'll take time to recover. Practically, that really should matter for people if they're real sophisticated investors, because it means they're not beholden to their investment account for liquidity. If you need it for liquidity, then it's a problem, right? Because, last thing you want is to pull money out into a drawdown, which a sovereign debt crisis obviously would precede, right? Deeper than what we've already seen. So, the question of practicality always matters in terms of how people themselves have set up their own risk profile, I would argue. So the most important takeaway from that is, if you're going to invest, make sure you actually invest, not trade, meaning don't look at the account, don't worry about the drawdowns, because drawdowns don't matter if you don't need the capital tomorrow.
I want to tie this back to, my original statement, your thesis at the start, that basically the world is, falling apart. Does this tie into the sovereign debt crisis you see, or more to the story?
Yeah, look, and that was a reference. That's a reference to a Twitter space I'm doing shortly. But the point about the world falling apart is that I think it's very clear that, especially with social media, you can't have any sort of logical conversation, discussion, or reason with anybody else. Everyone simply is in their echo chambers, and the world falls apart when you end up having people in their own worlds. I think that's really more the core issue.
You're absolutely right on that. I just want to pull up another tweet of yours, and maybe we can wrap on this note. I love this one, because it stars AOC. In September of 2021, at the Met Gala, she famously wore a dress that said "Tax the Rich." Since then, you say the U.S. Consumer Price Index rose 8.14%. Inflation taxed everyone but the rich. We need a dress on that the next time. How's that for food for thought?
And there was a little expletive after that, which we'll save. But and it's not a political statement in terms of Democrats. It's the hypocrisy of power, right? To argue to tax the rich, to say, here's the birdie, look at this, as the price of goods around you starting to spike among your constituents.
Exactly.
There has to be more accountability. There has to be more criticism, and rational, and not insulting, but real rational criticism around the way Democrats frame things and the way Republicans frame things. Because otherwise, we are going to have a real problem when you consider that, you got $30 trillion of debt, $170 trillion of unfunded liabilities. Oh, and by the way, your Social Security in a few years probably is not going to have anything left, given the way the government treats it. We have to start, as a country, start actually thinking, which I know is a big ask.
The hypocrisy is off the charts. Michael Gaid, it's been an absolute pleasure. Thank you for coming on.
Hopefully I'll have you on my Twitter Space show as well.
Absolutely. I'm honored, and I look forward to taking part. So come back again. Thank you again, and thank you all for watching. I hope you're enjoying the summer series thus far. We'll have more incredible content coming your way, so be sure to sign up at danielacambone.com so you can stay on top of all these awesome conversations. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.